Hi, and thanks for tuning in. I'm Andrew Lecook, moderator of our recent High Yield webinar entitled Tackling Spreads in Rates Discovery in Emerging and Frontier Markets. I'm joined today by Vikesh Mistry, Senior Modeler at S&P Capital IQ, who was the presenter for our webinar yesterday. Today, Vic will be answering 3 questions that we received from the webinar, but unfortunately we didn't have a chance to answer as we were coming close to our time limit. As a reminder, before we start, the webinar is available on demand if you'd like to watch the replay. This is accessible via the link provided in the email. So Vic, let's get started. The first question that we received from the audience was specifically around using a credit model score. And you talked a little bit in the webinar about when you might use a credit model score if, say, there wasn't a credit rating available for a specific entity. And the questioner wanted to know, with regards to a credit model score, is it a point-in-time measurement, or is it a measurement that is supposed to have a duration through a cyclical period?
That's a very valid question, Andrew. Anybody familiar with the S&P ratings, credit analysts' ratings, will understand that they provide a long-term perspective in terms of a credit assessment. So you could refer to that as being through the cycle. Now, credit model has been designed to closely mimic the ratings analyst processes in terms of generating a credit assessment. So the model essentially has been back-tested and trained on observed default data as well as ratings analysts' data, so as to produce a similarly long-term view in terms of a credit score. And the model output, in fact, includes a number of time horizons in its credit assessment. It's probably worth noting as well that the scores generated map directly to the rating agency scale, but simply on a lowercase basis.
Sure. And that can be particularly helpful when doing, say, internal communications and you're looking to work with senior management, and always easy if you can put it on the same scale where they understand the 3 letters and what they represent.
Definitely, yeah. I mean, I think that's one of the key factors in that it's transferable between regions, industries, but also that the scale is meaningful when assessing internal credits, let's say, using the scoring engine versus what the agency's perspective might be.
Sure. Okay. So moving on to the second question. This question was specifically targeted at the accuracy that you can derive from any model that you might be using in an emerging market. And I think what the question was really wanting to focus on was there might be specific data sets, maybe it's assets under management, maybe it's debt levels that might or might not be accurately reflected in some databases or might be particularly challenging to find. So I guess how accurate can your forecasting or your modeling be if you're dealing with certain gaps in the data?
So this is something that I would say that anybody looking to address emerging markets from an investor's perspective, or even as a corporation or institution, operating within one of those regions is achieving the same level of transparency and accuracy that we've come to expect from the developed markets. Okay. There's a process that we follow within S&P Capital IQ that aims to maximize the level of accuracy and transparency that we're able to deliver for emerging markets. And this is something that we've attempted to integrate into the models that we discussed during the webinar.
Okay. All right. So the third question was just asking for market participants, what might they use as a benchmark for any investments they have in emerging markets?
That's a great question that I'm sure a lot of our audience would love a straightforward answer to. In fact, many market participants would love a straightforward answer to. I would say that unfortunately, or even realistically, there is no single investment rate or hurdle rate that you would use for addressing an emerging market investment. You would certainly need to consider the individual market and industry characteristics when looking to derive such an investment rate. And again, this is something that we've attempted to address with the model by combining some of the characteristics in terms of our database information via the online platform and the analytical tools in terms of the screening and Excel plugin. What we have done in terms of integrating this within the models that we discussed during the webinar is take data for the price rated universe, combine this with the priced unrated universe, so referring again to credit model scores, and also leveraging data from our sister company, LCD, Leverage Commentary and Data, who provide information specific to bank loan information. So we aim to capture both the public and private debt capital markets to provide a holistic view of what might be the accurate benchmark rates and investment rates.
All right, well, thank you for your time and your insights today, Vic. Thank you to all of you in the audience. I'd like to highlight, as a webinar registrant, you're eligible to request a complimentary trial of S&P Capital IQ. If you'd like more information or to request a trial, please drop us an email via the email address provided on the screen now. And if you have any queries, please don't hesitate to contact us or visit us at spcapitaliq.com. All contact details are also provided in the email sent to you. Thanks again from all of us here at S&P Capital IQ.